With Toronto condo prices still lower year on year, are condos actually a better investment compared to other asset classes that have already seen massive gains? In this video, I'll talk about what caused Toronto condos to go in different directions in the past year and where Toronto condos might head moving forward. If you watch until the end, I'll let you know what I think about entering the condo market today. Don't forget to give this video a thumbs up and subscribe to our channel so that you can see more of this content made specifically for real estate investors in Toronto. So here's a quick recap of what's been happening in the Toronto condo market. Toronto condo prices have seen amazing double-digit appreciation for almost 5 years leading up to the pandemic. On the cash flow front, Toronto condos have never been that great, primarily because of condo fees. But having no cash flows wasn't a big issue for condo investors because they've simply been winning because of impressive appreciation. But for those who wanted better cash flows, there was another option: Airbnbs. Yes, condo rents don't necessarily cash flow positive if you rented them out as long-term rentals, but if you made them short-term rentals, then you can easily cash flow even better than freeholds. So if you were an Airbnb condo investor, you were doing crazy well from both the cash flow and appreciation standpoints leading up to the pandemic. But as you know, Toronto is in a housing crisis, and the city doesn't like the fact that you're taking units that can be lived in long-term and turning them into Airbnbs. And because of this, the city put an end to short-term rentals and finally started cracking down on them last year. Basically, Toronto landlords aren't allowed to run short-term rentals on properties that are not their principal residence. And so, if you were an Airbnb investor, all of a sudden your cash flows took a huge drop, and now you've downgraded to long-term rent yields. On top of this, long-term rents have also dropped, and now you're also faced with higher rent vacancies as well because less people need to rent downtown from both workers and university students, plus immigration was put to a halt. So instead of generating possibly positive $500 in positive cash flows on your Airbnb condo, you might be hit with a negative $350 instead, which is a huge $850 difference. And this definitely affects your holding power. If you watched my last video, you'll know that cash flows are important primarily for holding power, but the majority of your returns actually come from appreciation. So if you had a long-term rental before COVID instead of an Airbnb, lower rents and higher vacancies doesn't actually make a massive impact to your bottom line if appreciation assumptions remain the same. But this is a totally different story if your assumptions in appreciation have changed. You've seen it already. There's been a lot more supply in Toronto condos because investors aren't able to hang on to their negative cash flowing investments, and less people need to live in condos because they can work from home permanently. So perhaps demand for condos and hence appreciation might never be as high again. So if you're expecting high appreciation rates of 10% per year before, but now you've downgraded to 3 to 5% per year, then this will be a game changer in terms of your ROI projections. So here's the question again. Are condos a better investment now since prices have dropped? And here's my answer. If you're comparing it to how much an Airbnb investor was making in the past few years, it's definitely no. Condo prices have dropped, but you're looking at much lower rents, and even with lower interest rates, your rent yields are definitely still lower. However, if you're comparing your yields and cash flows now to long-term rent yields before the pandemic, they're pretty close because even though rents have dropped, interest rates have dropped a lot too, so that balances out with the current drop in condo prices. But as you've seen during the pandemic, condo cash flows are flat at best, which means during a downturn, you'll need more realistic expectations and set aside cash to chip in to cover operating costs when things get shaky. In terms of appreciation, it's possible that you can benefit from a one-time higher appreciation with condos because it is trailing behind freeholds, and that would mean that you would have better overall ROI. But that would be speculating, and I really don't like to do that. Instead, I recommend that you have a more realistic assumption for condos moving forward. Instead of expecting double-digit annual appreciation, or on the flip side, expecting no appreciation moving forward, use an average long-term appreciation assumption instead. You can set the bar lower and expect 3 to 5% annual appreciation, but for your reference, the 20-year average annual appreciation for condos in Toronto is around 7%. To help you form a better picture for future appreciation rates, let's go back to fundamentals. From the supply side, there's limited space in Toronto, so we can't expand like the suburbs. From the demand side, Toronto attracts a net influx of people, and demand will only increase when immigration and migration picks up again because people are naturally drawn to where the action is. So just from supply and demand, this points Toronto prices up in the long run. On top of this, Toronto gets the most attention from public and private sectors. This means economic recovery typically starts in the core. So all of these factors together help support the fact that Toronto condos are a stable long-term investment from a long-term growth perspective. Another big benefit for condo investors is that they attract the best tenant pool, and many renters are transient, which means they like to move around a lot. This means you'll have lower tenant risk, you're less restricted by rent controls, and you can more easily adjust rents upwards when rents recover. So having said all of this, condos can still generate around 20% ROI a year if you assume 3% annual appreciation. It's true that houses can generate better ROI because they can cash flow positive, but 20% ROI with condos is still really good if you can't afford a house. If you need help figuring out what is right for you, just reach out to us. We'd be happy to help you navigate the Toronto real estate investing front and match you with an investment property that actually fits your requirements and preferences. You can find out how to get a hold of us by heading to the link I'll put in the description below. Finally, don't forget to hit the thumbs up button for this video and share this video with any friends who might find it useful. If you want to hear from us more regularly, find us on Facebook, Instagram, LinkedIn, or subscribe to our mailing list, and you can find all of these links below as well. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.